Welcome to this explainer. If you're sitting there thinking accounting is just a bunch of dry math and endless boring spreadsheets, well, it's time to completely rethink that. It is literally the ultimate language of business. Today, we're taking 17 years of CFO-level experience, specifically across heavy infrastructure, and we're boiling the whole thing down. We're going to decode exactly what you need to know to absolutely master those complex finance interviews and turn textbook theory into true practical fluency.
Okay, here's our game plan for today. We'll be hitting 1, the language of business, 2, the rules of the game, 3, real-world journal entries, 4, managing fixed assets, and finally 5, provisions, reserves, and liabilities. By the time we wrap up, you'll be fully equipped to tackle the toughest finance interviews head-on.
All right, let's jump right into Section 1, the language of business. This is all about building our foundation by looking at what accounting actually is and why it's so critical for a company's survival.
So accounting is definitely not just mindless data entry. It's a highly systematic process. Imagine your company just bought 10 lakh rupees worth of steel for a massive railway bridge. Well, accounting steps right in to tell the story. It answers those vital questions. Who actually supplied the steel? Exactly how much GST did we pay? Which specific project consumed it? And ultimately, how does this impact our bottom line? Without this process, management is literally just flying blind.
Now, interviewers absolutely love to test if you understand the different dialects of this language. So right out of the gate, let's look at this. What exactly is the difference between financial accounting and management accounting?
It basically all comes down to your audience and your direction. Financial accounting, that is built for the outsiders, your investors, the banks, the government. It's strictly looking in the rearview mirror at historical data, and it uses mandatory frameworks like Ind AS. Management accounting, on the other hand, is for the insiders, the leaders. It looks forward through the windshield to drive strategic decisions, and it's completely tailored to whatever management actually needs to see to survive.
Moving right along to Section 2, the rules of the game. Now that we know the language, we really need to understand the core mechanics, those unbreakable rules that keep every single set of financial books perfectly balanced.
The absolute foundation of the whole double entry system is the accounting equation. Assets equal liabilities plus owner's equity. Try to picture it like a perfectly balanced scale. Every single asset your company owns, whether that's cash, inventory, heavy machinery, it was financed in one of two ways. You either took on debt or you used the owner's capital. No exceptions. This equation literally must always balance.
Let's throw a curveball your way. This is a great interview question to test your understanding of timing versus cash flow. Why is the accrual concept so important? I mean, if you just look at your bank balance, you might think you know how the business is doing, right? But interviewers want to know if you can see the bigger picture.
The secret here lies entirely in the accrual concept. It dictates that income and expenses have to be recognized exactly when they are earned or incurred, completely regardless of when the cash actually changes hands. Say you get an electricity bill for March, but it arrives in April. That expense firmly belongs in March. It's really the only way to get a true and fair view of your performance for that specific period.
And hey, we can't talk about rules without hitting the classics, the golden rules of accounting. For personal accounts, you debit the receiver, credit the giver. For real accounts dealing with assets, debit what comes in, credit what goes out. And for nominal accounts, debit all expenses and losses, credit all incomes and gains. Even in a modern world driven by incredibly advanced ERP systems like SAP, the underlying logic of these 3 rules still drives every single entry.
Which transitions us perfectly to Section 3, real-world journal entries. Let's step away from the theory for a second and put you directly in the driver's seat of a real business scenario.
Okay, picture this. Imagine you're working on a massive EPC project. Your company just bought steel worth 12 lakh rupees, plus an 18% GST, and it's specifically for a railway bridge construction. Start thinking about how a real-world event like this actually impacts the ledger.
But before we record it, let me pose a classic interviewer trick question. Why is that 18% GST not booked as an expense in your profit and loss statement? It's cash leaving your business, right? So why isn't it an expense?
Well, here is how the entry breaks down. The inventory account takes that 12 lakhs debit. But look at the GST. It's split up and debited into input CGST and input SGST, while the grand total is credited to your vendor. The absolutely crucial takeaway here, GST is actually an asset because it's recoverable from the government as an input tax credit. It's not a sunk cost at all. And that is exactly why it sits safely on your balance sheet, not on your P&L. Up next is Section 4, Managing Fixed Assets. We're pivoting now to the somewhat nuanced world of long-term value creation. Interviewers absolutely love testing this area.
You've really got to clearly draw the line between capital and revenue expenditure. Let's say your company operates a heavy crane. If you just do a routine oil change, well, that simply maintains the crane in its existing condition. That's a revenue expenditure. You expense it immediately. But if you spend 15 lakhs replacing the crane's entire engine, extending its useful life by another 5 years, you are actively enhancing its future economic benefit. That must be capitalized as a fixed asset on the balance sheet.
Now, imagine your company is spending crores to construct a brand new office building. The civil work, the electrical, the elevators, it's all happening right now. All of this sits in an account called Capital Work in Progress, or CWIP. But here's the tricky interview question. Why is depreciation not charged on CWIP?
The answer is actually elegantly simple. Depreciation basically reflects the consumption of an asset's economic benefits. So, if that office building isn't finished yet, those benefits aren't being consumed. Under standards like IND AS 16, depreciation can only begin the exact moment the asset is ready for its intended use, not a single day before.
Once the asset is finally ready, how do you actually depreciate it? Well, you generally have two choices. The straight-line method allocates an equal amount every single year, keeping things nice and simple. The written-down value method, though, calculates depreciation on a decreasing balance, which heavily front-loads the expense. If an interviewer asks which one you prefer, the golden answer is, it depends entirely on the pattern in which the asset's economic benefits are consumed over time.
All right, we are entering the final stretch. Section 5, Provisions, Reserves, and Liabilities. This is where we tackle the tricky areas of future obligations and exactly how a company handles its profits.
People mix up provisions and reserves all the time, but the contrast is actually really sharp. A provision is charged directly to the P&L because it's a known obligation. Think of something like unpaid audit fees, and it actively reduces your current profit. A reserve, on the other hand, is just an appropriation of profit. It's taking money you have already made and simply setting it aside for a rainy day. It doesn't impact your operating profit at all. It just flexes the strength of your balance sheet.
And finally, let's talk about contingent liabilities. This is basically how businesses honestly communicate uncertainty. It's a possible obligation that depends on some uncertain future event, like a pending lawsuit. Or maybe it's a present obligation, but you just can't measure it reliably. Or it's highly improbable you'll ever actually have to pay it out. You don't book a journal entry for this, but you absolutely must disclose it in the notes.
So when you step back, the really crucial point of this entire explainer boils down to this: a true and fair view. Whether you're balancing the accounting equation, correctly capitalizing an engine replacement, accruing unpaid salaries, or disclosing a messy contingent liability, mastering all these rules ensures that your financial reporting presents a legally compliant, true and fair view to every single stakeholder involved.
We've covered the language, the golden rules, the real-world journal entries, and the complexities of assets and future obligations. So I'll leave you with this final, provocative thought. If accounting truly is the foundational language of business, exactly how fluent are you willing to become to confidently conquer your next big interview and drive your organization's future? Study these core concepts, internalize the logic, and I promise you'll be speaking the language of business like a seasoned expert in no time.